Welcome back, friends, to Alpha Beta Soup. I'm TXMC. The last few videos, we've been really studying recessions, how they're officially measured, how we could measure them better, how it maybe relates to what's going on with Bitcoin and other parts of the market. And if you're new to the channel, I highly recommend you go down to the description of this video and click on the link that takes you to my Recession Roundup series, and you watch the previous videos. There's a lot of really cool charts and analysis in there that I'm particularly proud of, and it helps to lay the foundation for what we're talking about today and what will be relevant in future videos over the next few months as we follow the economy very closely. And what we'll do today is continue some of that perspective. This video won't be made part of that series, but it will have much of the same topics and matters of discussion. We have a new lens to look at the economy through as it relates to our recession study, inspired by the chart you see here on your screen, and we have many things to talk about. But before we get started, a little bit of housekeeping. If you enjoy my content and you'd like to see more, make sure to give this video a thumbs up and please subscribe. Your engagement helps this channel to grow, and if you share it with your friends, that's an even bigger boost. Thank you for all of your engagement. Also, none of this is financial advice. I am not suggesting to you how to invest your money. You should not put anything at risk in the real markets without doing your own personal research. I am just a dude on the internet. Don't listen to what I say. But I do hope you enjoy it, and we have much to discuss. So let's get into it. Where we begin today is with this chart right here on your screen from one Arturo Estrella, who, when I looked him up on Twitter, turns out he is a PhD in economics from Harvard and the professor emeritus at a place called RPI. So it seems like they like to look at the economy. What they're showing on here is a chart of employment based on the amount of months that have passed since the inversion of the yield curve. If you've been following this channel, you know that the 3-month 10-year is our yield curve of choice when studying recessions. It's the one that we've used in all of our modeling, and so this chart fits nicely into what we have been studying so far. Now, the way it's laid out here is important to grok. The x-axis is months that have transpired since the yield curve first inverted. In the gray line are all of the times that the yield curve inverted between 1968 and 2018, so pre-COVID. The red line is now. COVID has been left out of this, presumably because COVID breaks all of the charts. Everything kind of goes straight down in a big V, and it's hard to get historical trends. So I guess it makes sense that they left it out here. And what I want to do is talk about this chart, but also look at this exact same perspective, but with the other metrics that we've been using to study the economy, right? We've been looking at a lot more than employment, at things like retail sales, wholesale sales, consumption, income, corporate bond spreads. We've looked at everything. So let's take this exercise forward. But before we do that, we have to recreate this chart with our data set, right? Because I don't know Arturo, I don't have access to this data, but we need to reconstruct it. And here it is. Look how beautiful that is. It's a picture-perfect match to Arturo's chart over here. I always like when I'm able to reproduce someone else's chart using my own data set, and it lines up perfectly. So what we're looking at here is months that have transpired since the 3-month 10-year yield curve inverted, and this is employment through the lens currently of non-farm payrolls. You can see that named up here at the top. The lighter gray line is all of the eras from 1968 to 2018. The black line is 2022 and 23 currently. What I've added in for extra flavor, which is not on Arturo's chart over here, is the month in this process that all of the recessions began, the prior recessions. We've got 7 of them listed here. You can see 1973 to 75, this era's recession began 7 months after the yield curve inverted. 2000, it was 10 months. GFC was 18 months. So this is how this chart works down here. And when I look at this chart, a couple of things jump out at me. The first thing is, well, labor is quite strong, and historically, it appears to be quite strong for many months after the yield curve inverts. But it does appear that on an historical average basis, labor really starts slowing down when you get about a year past the yield curve inverting. That would be right here at number 12. So it's really about a year grace period that you get from the time the yield curve flips backwards before the labor market starts to show weakness and it starts to soften. Now, if you recall from our previous study, the labor market is one of the more sticky and stubborn parts of the economy. It's one of the last ones to move, right? We see weakness in other places first. If you recall back to this visualization, which we looked at in the first part of the recession series, this shows the average growth rates of many of the metrics that we use to watch the economy. These are the ones the NBER finds important. Leading into recession, many of them remain positive. Things like employment, personal consumption, personal income. The growth rates on those stay positive until we get to when the recession is officially dated, which is right here at this 0. And then a couple of months later, on average, labor softens and it goes negative. Incomes and consumption likewise follow. As people lose their jobs, they lose their income and thus can't spend as much. But those things don't happen until later in the period of softness, more in the actual wheelhouse of the recession. But when you look at stuff like industrial production, real manufacturing sales, which is wholesale, real retail sales, those things look a lot softer in the months leading into what ends up being a recession, right? So we've got some leading factors and some more laggy factors related to labor itself. So when we look at this chart of payrolls, it kind of makes sense. The yield curve inverts, the recession starts, and then labor gets weak a little bit afterwards. We have a few recession starts before the average labor fractal really starts weakening. This aligns with our view from the chart we just looked at. But let's look at some of the other metrics, right? We know non-farm payrolls does this arc, and maybe we're a few months away from really expecting to be in that sweet spot where labor would show weakness, right? We've got some more time before that's more likely to occur. This is the household employment survey. This is the other side of the labor market. You've got the non-farm payroll number, which comes from the establishment survey, and then you've got the employment level number, which comes from the household survey. And those are the two that come out as part of the jobs report. So household employment looks similar. It's a more choppy series, but it has a similar arc. It's going up very strongly, and usually about a year past the inversion of the yield curve is when things start to get real spicy. Let's put this on presentation mode, make this a little easier to see. So we've got household employment, also looks kind of similar. But then let's move forward. Let's look at some of those more cyclical aspects of the economy. So we'll look at industrial production. And when you look at it this way, the current fractal looks quite weak compared to the average of all of the prior eras, right? This is where we are currently today, and this is the average of all of the prior times the yield curve inverted. So for more than a year after that happened, on average, industrial production remained above its highs. It remained in expansion. We are here currently below the highs, or at least below the high from when the yield curve inverted, and we're in a kind of a contractionary period for industrial production. Real manufacturing sales also looks kind of weak compared to the historical average, right? Retail sales looks very weak. It's a full percentage point below the average at this point in time. It's trailing considerably below the long-term series, even for something like real retail sales that we know gets weak very early. Real consumption also looks a little weak. This series is not one that goes straight up and then comes straight down because consumption isn't exactly the same in every downturn. Sometimes it stays a little more sticky. In other times we have much bigger job loss and consumption tapers a lot more sternly. So this fractal is a little different from something like non-farm payroll, which is very consistent. However, we are trailing below the historical trend on consumption growth since the yield curve inverted. Real incomes look very weak and anemic compared to the historical series. So we've got a few factors lining up here. When we look at the cyclical aspects of the economy, they look weak, they look anemic, they look underpowered relative to what the economy is normally doing before we even get to recessionary periods. We're just now getting to the threshold where the earliest recession began in relation to the yield curve, and we're trailing quite a bit below the trend on real retail sales, on wholesale, on consumption, on income, on industrial production. All of those look rather anemic. But these are averages, right? This is an average of the series. So it's important that we also take this view and look at the entire group broken out and see where we place within that. This is that view. This is the exact same data set as this one over here, but all of these series down here have been broken out of this gray line. And this is what it looks like. Here we are, right smack dab in the middle on non-farm payrolls. You can see how they all arc upwards, and then 12 to 18 months after the yield curve inverts, that's kind of all she wrote, and labor softens after that. That's also most of the time when the recession has begun. Continuing forward, the same order we did earlier, household employment. We're near the top of the distribution on the household survey of employment based on when the yield curve inverted. So we have quite strong labor growth, historically speaking, for this period of time, and we see that in non-farm and in the household survey. If we combine those two together, which I did just to kind of take out some of the noise, this is a blend of the two employment surveys, and you can see we are near the top of this grouping amongst all of the prior eras. But let's keep going forward, right? Let's look at that cyclical stuff. Here's industrial production. Here's where we are. We're below almost the entire series. The only era that it's a little bit worse than what we are today was the 2000 period, when industrial production really started tapering down about 5-6 months after the yield curve inverted, and it's a little below where we are now. You can see that here, the green line versus the black. We are below all of the prior eras in performance for industrial production. We are below trend based on this period of time. Let's keep going. Manufacturing sales. Okay, kind of a cluster, a little bit less conclusive than a couple of the other views. However, still on the low end, right? We're down here. Much of the group is up here and showing positivity, whereas currently real manufacturing sales is kind of chopping along and not really going anywhere and is contracted from its high. At least its high when the yield curve inverted. Continuing on, real retail sales, one of the ones we said was extremely anemic. Look where we are. Similarly to industrial production, on real retail sales, we are near the bottom of the distribution. We are underperforming the long-term trend of retail sales relative to the yield curve. We're underperforming retail sales. We're underperforming industrial production. We're slightly underperforming on manufacturing sales. Let's keep going. What about real income growth? Real income growth is literally the worst it has been in all prior eras of the yield curve inverting. Consumption, a little more positive, a little more constructive. We're in the middle of the grouping, though we've kind of been clustered near some of the less impressive eras. But we know consumption can stay sticky, and right now consumption is one of the things powering the US economy. We are still running on the heat generated by the stimulus from COVID. The amount of money printing that occurred in that 2-year window from early 2020 until early 2022 has created so much buying power in the US economy and so much distortion that we've had negative real wage growth for the average American worker since April of 2021, yet the economy continues to grow. Consumption remains positive. So consumption is still moving forward, but when you look at some of the other cyclical parts of the economy, they are underperforming. They are near the bottom or trailing below the long-term historical trend for this point in time relative to the yield curve for all of these cyclical leading parts of the economy that we have pointed out currently are the only 3 in contraction, whereas the other metrics looked at by the NBER remain near their highs, and these are the 3 that lead into recessions. The picture is coming together here, friends. When no matter how you slice it, in any of these various metrics, we are near the bottom of the distribution of the historical series. And it has me concerned. I don't know what that means for the severity of the recession. It's hard to tie these observations directly to a percentage in loss of GDP or in loss in the market, because those variables are highly dependent upon the criteria that push the economy into a downturn. But the story that we take away from these observations is that the economy does not look very strong. There are aspects of it showing strength, yet when we look at some of the things everyone's paying attention to, which is labor, that seems to be sucking all the air out of the room whenever we talk about the economy. It's the labor market. Well, everyone's expecting to see weakness there, but if you look at the series and you see when things really break down, it isn't until well after a year beyond the yield curve inverting for almost every one of these series, almost all of them. And currently we're all the way back over here. So I think that we've got many more months of this to go. We might have a whole other year of this left to play out before we really understand everything that's coming ahead. And when I see how long these kind of sagas take, this is ammunition for me to turn down the volume on people like on Twitter that are constantly demanding, why isn't the recession here yet? There's no way we're going to have one. Look at what the economy's doing. It's taking too long. The lows from October were 9 months ago. Why are you still talking about about that? What are you worried about a recession for? Look at real GDP. Look at the Atlanta Fed GDP now. Look at the labor market. Yada, yada, yada. All of these excuses, when you look at them through the lens that we are here on Alpha Beta Soup, all of them wilt under scrutiny because this process takes longer than anyone in the mob actually expects. And in my estimation, a large reason for that is because people were expecting the recession last year, and we did not enter the true window of danger until now, until this time of the year, until Q2, Q3 of this year, as we approach the front end of the distribution of all the prior economic downturns based on what's happened so far. That's what we're looking at here on this chart. So from the perspective of labor, which is the focus of the Fed, and it is the focus of many of the talking heads on Twitter, on CNBC, and elsewhere, they're looking at growth in jobs, and they're saying there's no sign of a recession. And they're right. There's not a sign of it quite yet. But as we've observed, there are certain things that are sending up smoke signals, and when you overlay many of those signals together, you get a confluent story. It's telling you that we need to be on high alert for the rest of 2023. People may not want to hear that. That might not sound very exciting. Maybe they want some bullish news. Maybe you're tired of being bearish. Maybe you're tired of me being bearish. Well, let me tell you, friends, I'm tired of being bearish. I want to be able to go gig along into the market and ride it up to the generational highs. I would love that. But everything I'm looking at tells me that we are too early to leap to that conclusion, and that we are better served giving the market more time to show its hand to us. We are 7 months in to an actual danger window that is nearly 2 years long. And let me show this to you in a different way. This is a look at the timing of the lows of the market based on when the yield curve inverted, and with an extra layer of detail when the recession began. So let me talk you through this chart. On the x-axis here, we have the amount of months that have passed since the yield curve inverted. It's the same way the x-axis is set up on this chart here. So we've got months that have passed since the yield curve inverted. Up on the left side, the y-axis is the number of months since the recession began. We know that the recession typically comes after the yield curve inverts. It is dated in hindsight rather than in real time. And whenever the yield curve has inverted, we have had a recession. So the two go together. Each of these circles represents the placement of the absolute low of the S&P 500 in this matrix here. And what you'll observe is that if we look at the x-axis and we look at where the 1 year mark is, which is right here at this 12, there is only one prior era where the bottom came in less than a year after the yield curve inverted. It was COVID. It was an artificially driven economic downturn forced by the shutting down of the entirety of the services sectors of the economy. We had global lockdowns, right? And the low of the market came abruptly. It came in like a 6-week period. We fell from February to the end of March straight down 35% on the S&P. And that low was 10 months after the yield curve inverted. All the other prior lows came more than a year after the yield curve inverted. The two soonest, 1990 and 1974-75, were 16 and 17 months after the yield curve inverted. When did the yield curve invert for us now? It was in October of last year. We are 9 months out from that happening. So if we look at this visualization and we look at it here, and let's just assume we're going to have a recession. So let me draw my box and let us doodle on this chart a bit here. So first of all, starting out, the yield curve inverted in late October last year. So we're 8 or 9 months out from that period of time, right? So we're right here. This is us. Now, we haven't had a recession yet. We don't know when or if that's going to happen. But on the x-axis from left to right, our current era is right here. Now, if we consider this is the soonest bottom that we've ever had in relation to the yield curve, and it was freaking COVID. There's just no other comparison to this point in time. So we can't really use that. Where are the next lows? They're here and they're here. They are 8 months away in a realistic sense if we're going to follow the general mean of history. And you can see that many of them are clustered here in this kind of 16 to 22 month period after the yield curve inverts. We have the bottoms of 1, 2, 3, 4, 5 different market eras. 2 of them, 07, 09, and 2000, the 2 worst drawdowns in many of your lifetimes, times. Those came more than 2 years after the yield curve inverted. These represent, in our hypothetical today, late 2024, early 2025. I don't think anyone wants this scenario to play out. So let's just pretend that it's not going to, and that we are somewhere in this grouping here to be more realistic about it. We still have all this time to traverse. We're at the 8 or the 9 on my axis, and we need to get to like the 15, the 16, the 17, the 18. So we're talking about the end of this year. We're talking about maybe Q4 of 2023, maybe Q1 of next year. Based on historical averages, based on splitting the group down the middle, that's usually when the low of the market is, based on when the yield curve flipped. So again, we've got another perspective here, showing that we're all the way back here, and people are expecting the lows to have been in October, when history is saying, no, you're probably 6 to 9 months or possibly longer away from that happening. Then you look at something like this, at labor, at the arc of labor, and you see how we're following the trend, but it's not telling us anything yet. But it won't for many more months if history has anything to say about it. And from a total distribution perspective, labor's not the place to look. If we look in other places, we look pretty weak. We look anemic. We're trailing near the lows or at the lows of the long-term distribution for many of these metrics. Look at real income. Now, this is amazing when you consider that real income got the largest stimulus boost in U.S. history in 2020 and 21. People were given a couple $1 trillion collectively to spend on whatever the heck they wanted to. Now, many people have already spent that money. It's not currently sitting in the bank. But that money, on top of record wage growth, generationally high wage growth, extremely tight labor markets, a PPP loan program that had over $1 trillion of completely forgiven loans that were never paid back. All of these factors, when you lay them on top of each other, they created an incredibly overjuiced U.S. consumer on a national average basis. Some people have more money than others. Some people are really struggling. I'm aware of those nuances. But when we look at just the average American, right in the middle of the group, they have more money in their bank account than they had before COVID began. They're looking around and wage growth is 4 or 4.5% year over year, which is the highest it's ever been in some people's lives. So consumption is still sticky. People's incomes are growing at a strong pace. But because of inflation, nominal income growth is one of the strongest measures that we have had in several generations since the 1970s. In the next few months, sometime in September or October, it's expected that Americans who have student loan payments will begin to have to make those again. Some people have not paid on their student loans in 3 years. Those represent multiple $100s a month that is now going to be pulled away from consumption. They won't be ordering as much food on DoorDash. They maybe won't be going to the movies as much here or there. They're going to have to cut back because they're going to have to start paying their student loan bills again. We don't really know how that's going to weigh on consumption. Some people believe that it won't have any impact at all. Others believe it will have a significantly measurable drag on consumption growth. We won't really know until later this year and early next year as the comps start rolling in, the data starts rolling in. But based on the timelines here, when we look at how things normally play out, we have a lot of time where labor will continue to be strong. Now, the market could perform in this environment. It can continue to be choppy and sideways. It could be slightly elevated. I doubt that it's going to continue its straight up movement like it has for the last month. Maybe it will. Regardless of what happens with the price action, it doesn't change any of this story. And that's what I think is really important to take away from our video today. Not just that things look weak. When we look at historical averages, we're below many of those trends. The metrics that we said are important, like industrial production, manufacturing, retail sales, those things look quite weak compared to history. All that stuff is relevant. The amount of time that it normally takes for us to actually get to an action point is much longer than people assume. But the real takeaway, the thing that I think it's impossible to overstate how important this is. There is not a price on the S&P 500, on Bitcoin, on the Dow Jones, on the NASDAQ. There is not a price that will tell us the recession is avoided. That just isn't how it works. The market is not the economy, though they are closely related to one another. The market can be wildly irrational and exuberant, as we have seen, while the economy continues to deteriorate. We have much longer to go on this, and there is is no price that will change the trajectory that we are on, because signals have begun to flash. The economy will slow down as a result of the gargantuan hiking saga that we just went on over the last 15, 16 months that may not be over yet. So if we're going to bundle this whole video up into a couple of takeaways, they are these. This process takes a long time. Labor can be strong until more than a year after the yield curve inverts, and we're only 7 or 8 months into that process. And then everything kind of deteriorates at once. But labor is one of the last things to tell you that we have a problem. But if you look in other places, in the cyclical part of the economy, in the places that lead us into a downturn, they're telling you a story. It is unambiguous. And in many cases, it is considerably below the long-term trend of all prior yield curve inversion eras. When we look at how much time it takes for the low of the market to be established after we have an inversion, in many cases, it is over a year after the inversion. In only one instance was it faster, and that was COVID, which was artificially driven down. All of the others were 16 or 17 months or longer afterwards. And again, we are over here on this timeline. We're all the way over here. We've got at least half a year to go before we find ourselves in the historical sweet spot. Now, that doesn't mean we have to follow these trends, but what it does mean is that anyone who thinks that just because we haven't had a downturn yet that we have avoided it, those people are just wrong. They just have not done the work to know the truth, and you are seeing what reality is on your screen. So I remain very dubious. I will continue to watch these metrics. We will update this chart as the year goes by. We'll continue to check in on it. We'll look at some other things too, but keeping a perspective is the most important thing. And you know, this is far and away the most difficult period of time of the last year and a half for my thesis about the market. I've been worried that we would have some kind of a recession since early last year, but I hadn't yet done enough of the work in the research to really be able to articulate that view and back it up with data. Well, that's what I spent the last year doing. And when I see everything that we've talked about today and in the prior 4 videos, I see that these sagas take multiple years to play out. In many cases, they are 2+ years. And often, they don't really get started until a few leading indicators begin to soften. Things that we've talked about in the previous videos. Things like manufacturing sales, like industrial production, like retail sales, like the housing market. Those things soften first, and all of those have already peaked. But things like labor, where everyone appears to be focused, those can remain quite steady until over a year after the yield curve inverts. And we're all the way back over here in that process. The chart in front of you is telling you, you need to give this another year. That's hard to swallow. That's hard to tell people on a weekly basis that we are months away from knowing what's going to happen. It's not going to be clear next month. And we didn't even really enter the danger zone window until late last year, until we had the topping of several of the metrics we mentioned, the industrial metrics, manufacturing, retail sales, all of those peaked, the yield curve inverted. We've got the Fed actively raising rates to slow the economy down. Everything's kind of lining up, and people are really eager to hear clarity. They're clamoring for me to provide a window of time that they can go bullish again. They want to know a clear metric that they can follow that will invalidate everything that I've been saying. But it's too complex to give that kind of an answer. The economy is a massive, interwoven, dynamic system, and there is no way to boil it down to just 1 or 2 metrics and say, when that number is X, everything goes to shit. That isn't how it works. And I know that people want that, but I can't give them that. And the biggest disconnect that I see when I talk to people in places like Twitter about the economy, about the risks of recession, is people want to believe that there is a price on the index that will invalidate the possibility of recession. But let me emphasize this point as clearly as I possibly can. There is not a single price on the S&P 500, on the NASDAQ, on the Dow Jones, on Bitcoin. There is not a price under the sun that you can name that would prove that the recession can't happen. The price is not the economy. The market can do whatever it wants. It can remain exuberant and irrational in the face of economic deterioration, which is literally what we have been seeing in 2023, right? Risk markets have been shooting to the moon. Meanwhile, economic data keeps getting worse. And one of the most salient indications that a downturn has a ways to go is when investors continue to flip bullish while the underlying economic structure continues to weaken. It's exactly what's happening right now. When we look at the price charts, we can draw Fibonacci retracements. We can say maybe it's going to stop at the 702. Maybe it's going to stop at the 786. But those are just possibilities. And whether it does or not, or goes all the way up to the previous all-time high and breaks down or not, those are completely immaterial to my thesis. Nothing in my thesis is related to the price of the market. What does interest me is where the low is established relative to all of these events that we've been following, all of these economic events, these signposts in the road, different things peaking, things rolling over in rate of change terms. That's what's important. And there's no place on the S&P that we'll get to that will tell us that we're okay and we're home free. And as many of you recall from the previous video, if we do have a recession in the next year or two, like we think is extremely possible based on everything we've been studying, we could take out market lows from 2 or 3 or 4 or 5 years ago. So that's why the October lows aren't safe. In almost every instance of recession, we've taken out lows from at least 2 years ago, in almost every instance. So if you're going to take anything away from the video today, yes, we're currently on the trend for labor. Labor looks strong, but the chart is showing you here that labor doesn't matter right now. It's supposed to look strong right now, and it doesn't really start to look weak until maybe a year or more after the yield curve inverts. But many other things about the economy are trailing considerably below the historical average for this point in the market cycle. Things that have me very concerned, things that normally lead us into a recession. And in the cases of some of these metrics, they are the worst performing of all prior eras of yield curve inversions. When you see how long it takes for things to really start breaking down and recessions to begin, denoted down here, it's 10, 11, 14, 16, 18 months later after the yield curve inverts that the recession is really in full bloom and everything's kind of turning down together, which is this view here that we studied from the first video of the recession series. Everything kind of goes along until it doesn't anymore. And the metrics that look the weakest on the way into that period are what, friends? You're tired of hearing about it. Industrial production, manufacturing sales, retail sales. So that's what I wanted to talk about today. We will check back in on this chart. We'll make other ways of looking at this data, and we will stay updated on where we're headed and if we're following the fractals of the past. If we're going to have a soft landing, if we are not going to see the economy turn down and instead it is going to return to expansion, then we should hope to see things like this come eventually back up here and then go straight up. Industrial production. Things like real manufacturing sales stop contracting and turn up. Real retail sales stop going sideways, contracting at 2%, go up. If all of these begin expanding and we get over here, we get past the 13, 15, 18 month mark from when the yield curve inverted and everything still looks rosy, maybe we can start to feel like maybe we dodged a bullet. Maybe we thread the needle. But that's far in the future. It's too hypothetical to talk about now. But that's kind of what we would be hoping to see if history is not going to repeat itself and if this time is going to be different. Make sure that you follow me on Twitter right here at TXMC Trades. And that's where we'll leave the video today. I really wanted to show you that we are on the trajectory of past eras. If anything, we are underperforming in a lot of cases, particularly those leading metrics that are so good at letting us know the economy is weakening and we should be on alert for recession. But we also saw that we have many more months to go before we can start to try to draw any conclusions about what's actually going to happen. The market can kind of do what it wants over the next few months. We're already up considerably, so it wouldn't surprise me if the momentum slows down or even reverses at least for a month or two. But where the market goes doesn't matter. It's where the economy goes that is so important. And depending on how long it is before we have the next bout of high unemployment and a real recession, if it isn't far enough away from today, then the lows from October are not safe, and we will set new lows that will take us back into mid-2020 prices. There is still a high high probability of that happening, and we will not feel safe for at least 6 months, 9 months, or more, depending on how all of this rolls out over the coming quarters. So I know you want clarity. I know some of you want me to give you a big fat target to aim for, but it's really the end of this year, Q4, Q1 of early next year. That is the mega sweet spot where you have a lot of confluence of different factors, and that's where we have the highest chance of getting some clarity about this business cycle. But that's it. I keep saying I'm going to stop, and I don't stop. This time I will. I love you guys. Thank you for watching the video. Please subscribe to my content. Please share the video, give it a thumbs up, and we'll talk again in a few days. If you have any questions or feedback for me, make sure you leave them in the comments below. I see every comment you guys leave. And with that, I'll let you go. So until the next time we speak, take care of yourselves, take care of your families, get outside and touch some grass, and you and I will reconnect here in just a few days. Cheers, friends.